First, though, Friday's jobs report showing a modest increase of 138,000 jobs in the month of May. This coming in far below the 185,000 expected. Joining me right now is the chairman of the FDIC, Thomas Hoenig. It's good to see you, Mr. Hoenig. Thank you so much for joining us.
Thank you for having me.
So I guess let me begin. I want to ask you about regulatory relief and what's going on in terms of the rollback there. But let me begin with your expectation of the economy right now on the heels of that jobs number. How do you see things?
Well, the economy is doing very well right now, and numbers will vary as they always do. And we're in the process to moving from one equilibrium around zero to a new, whichever that is. And so that's going to be a delicate matter. So we will have ups and downs. But right now the economy is very strong.
How much would you look toward fiscal policy to sort of lift things up? Because here we have the administration trying to execute tax reform and health care reform and all of its policies that focus on jobs. Do you think that's a big component of what we will see? Do you expect that we'll see 3% growth as they're predicting?
Well, I don't know what the growth rate will be in the future. I know the fiscal policy will be a difficult process, right, given the size of our debt and our deficit and so forth. So it's going to be a challenge. But how it all comes together, how monetary policy then fits with fiscal, and how the economy more generally is doing with demographics and so forth will define whether it's 3% or 2% or whatever the final number is.
But I guess my question is, to fiscal reform, do you think that will be impactful if we were to get tax reform?
Would it be impactful? Of course.
Growth.
Depending on how it's structured, of course, it could be very positive in terms of how people look at it. Or if it's done poorly, then we'll have a different outcome. But who can predict? Regulatory
reform has also been part of this whole growth story.
Yep.
You are proposing to separate commercial and broker-dealer investment banking activities.
Right.
Why do you believe this is a necessary move?
Well, I think everyone knows that a strong economy requires a strong banking system. And if you think of it today, our largest institutions remain too big to fail. It's just a fact. They have, therefore, taxpayer has to back them up. That's a subsidy that they receive, and therefore, it's like giving like the airline industry fuel subsidy, part of it and part of it not. So what I propose is that for the largest organizations, they reorganize themselves around having the insured commercial bank and the broker-dealer capital markets separated under common ownership, but they have separate capital, separate management, and they are priced in the market separately based on the relative risk of the two activities through issuing a non-voting Class B shares. And therefore, the market starts allocating towards risk rather than the regulators. And as a result of that, you also then can have a more transparent. There's one other thing, and that is that you have to raise the capital level of the largest banks to the same levels of what we expect of our regional and larger community banks, which aren't too big to fail. So now you have a very competitive market, a very open market, and now you can talk about reg relief.
Yeah.
The reasons that you can is that you now have this more competitive market, safer market in terms of the pricing in the marketplace, and therefore you can for lack of a better, that you can begin to, you don't have to get permission to pay dividends. The living wills process can be simplified. And there's many others around the Basel capital standards that can be simplified. So now you free up the market.
I totally understand that. And I like the idea that you said it could be under shared ownership. The two companies, the two sides can still be owned by the same company.
Right.
That's different. I hadn't heard that nuance before.
Right. It takes the argument of whether you should completely divest and have Glass-Steagall away, and it says, but you are going to be separate, you are going to be accountable in different ways in the market, and that you get a better outcome. Now,
Jamie Dimon, Chairman and CEO of J.P. Morgan, might push back and say, look, we are a better and more helpful to big businesses being a large bank, because if IBM or a large company calls us and says, look, I need a complicated lending situation, we can go into where we have our deposits, or we can do the deal, and we need both parts of the bank to actually facilitate that complicated piece of business.
Right. And we keep that, but you confine the subsidy to the insured commercial bank rather than the entire organization. So they can go anywhere in the world. If they have a capital markets need, they can provide it. If they have a lending need, a commercial bank lending need, they can provide it. If you're going to trade, you can trade in your non-bank capital markets unit. So you have everything there, but you confine the subsidy, and you've made it more competitive, and you've made it safer. So now we can have real economic growth based on the market rather than some administrative rule around how much dividends you can pay this time or next time.
Well, you make a good point. The market will decide that.
Yes, it will.
And that's what you want.
That's what you want.
So let me ask you about lending in general, because a lot of people feel that the reason that we saw a real slowdown in lending over the last 10 years is because the rules were just too onerous. Yeah. Is that what you saw, and where are we today in terms of lending? Has it loosened up?
Yes, lending is more available. I mean, we've seen consistent increases in loans over the last 3 years without any question. But let me make something clear. Capital, which is one of the reasons they say we've wanted too much capital from them, is wrong. The research today shows that the better capitalized institutions are better able to lend, and in a downturn are better able to stay with their customer. And the one thing that happened in the last crisis, because they were so low, so poorly capitalized, is that they had to shrink like crazy. And, of course, the economy suffered dramatically. Right. What we want to do is prevent that going forward.
And so you think this plan to separate broker-dealer from the bank would do that?
It would clarify where risks are, number one, and the capital levels up to where the uninsured, I should say, the not too big to fail firms are, would give us a stronger system overall. And, yes, we'd see better lending, and we'd see a more responsive industry to the market.
Well, the other issue is that we have larger banks and then smaller banks, but they're all following the same rules. So should a J.P. Morgan be subject to the same, or should a small regional bank be subject to the same rules that a J.P. Morgan is subject to, or a Bank of America is subject to, where they have so much more resource to deal with it and expense?
The answer to that is no, they should not be. But the reason that they are is that these rules are defined around the largest J.P. Morgan and so forth. But if you simplify the system as I've described it, that is, you've reorganized it as I've described it, then you can take those rules away that are specifically designed for the too big to fail. And now you have a more competitive market, and everyone is treated as a level playing field, and you get better outcomes.
How do you recommend the practicality of this? Let's say you spin out or you separate broker-dealer. Are you saying spin it out? Are you saying two public companies? How do you see that?
You can organize it, you can spin it out, but under the same ownership at the top, but with separate companies, separately capitalized, and the broker-dealer would be capitalized one way based on the market and how its stock trades. It's Class B, non-voting stock, and the same for the commercial bank. So then you have these two organizations. The market can trade it. So if you're getting into high risk in the broker-dealer, more than what the market thinks, it'll begin to affect that price, whereas the commercial bank will be another. So that people can see it's not cross-subsidized as it is so much today.
I understand. We just had Congressman Andy Barr on, obviously on the monetary subcommittee. Give us your timeline real quick before we go. Where does this go now, and when would you expect this to really gain traction in terms of the conversation?
Well, I think the House will move its banking bill in, and then the Senate will discuss this, I hope. I propose it. I hope it becomes part of the discussion and maybe a basis for a compromise and maybe a good outcome.
Thomas Hoenig, great to have you on the show.
Thank you very much for the opportunity.
Thank you so much. FDIC Vice Chairman Thomas Hoenig joining us.